Start with chapter 3.
Yes.
Sole trader. Sole traders, partnership, social enterprise, and franchises. So we have a case study here about Mariana Bello. So the case study is there for anybody to read, but I'm just going to go to, I read it already, so I'm going to go to the questions. They said, who owns the business in the above two case studies? So the business is on, for the first case one, they said Mariana Bello owns a cafe in Sevilla. So Mariana owns the first business. Mariana owns the first, Mariana owns the cafe. So the first case study is owned, the business is owned by Mariana. Clear. Then for the second one, they said the Alta Dental and Implant Clinic is an established dental practice in Dubai, UAE, which is set up by experienced dentists Khalid Said and Ismail Mansour. So the two owners of the Alta Dental is Khalid and Ismail. Clear.
Yeah.
The second question says, discuss one advantage and one disadvantage of owning a business. So with a partner. If you are owning, the advantage of owning a business with a partner is that you can share skills and ideas. That's an advantage of owning a business with a partner. You can share skills and ideas. That's an advantage. And you can even contribute more capital to the business. But the problem is that you have to share the profits. Do you understand?
Yes.
So advantage is that disadvantage is that all profit is shared. Profit are shared. All profit are shared. All profit are shared among partners. Among partners. All risks are shared among partners. Okay, all risks are shared among partners. So that's an advantage. Okay.
Yes.
Advantage. Okay. Question 3. He said, what risks are taken in the above case studies? The risk taken here is that they invested their capital, their money, their own savings into the business, which they might lose. Do you understand? So like both partners, they invested 200,000 each to the business. So that money might go. And for Marina, she invested 20,000 into the business, which might go to if the business fails. So that money is gone. Do you get it?
Yes.
So that is the risk involved. Clear? Now we go to entrepreneurs. Who are entrepreneurs? Entrepreneurs are owners of the business. They are the people that set up businesses. Clear? All right. So what are the roles, the functions of entrepreneurs? One, they are innovators. So we call them innovators because they make money through business idea. They come up with business ideas and make money from it. That's why we call them innovators. Two, they are organizers. They are organizers because they are the ones that manage and control all the factors of production. Land, labor, capital. They are the one in charge. They control them. They arrange them because they are the owners of the business. Clear? They are risk takers. Why are they risk takers? They are risk takers because they put their own money into the business, which might not come back. Do you get it? The last, okay, I did the third one before the fourth one. The fourth one is about decision makers. They are decision makers because they decide the operations of the business. They decide what the business wants to become. They are the one that takes the decision. That's why we call them decision maker. Is it clear? So that takes us to incorporated and so we have two types of businesses. We have unincorporated business and incorporated business. Why do we call it unincorporated business? We call it unincorporated business because there's no legal distinction between the owner and the business. That means the owner of the business and the business are the same. So you cannot separate the owners from the business. That's why we call them unincorporated. Do you understand unincorporated? The owners and the business are the same. So whatever happens to the business happens to the owner. Clear? For incorporated business, these are businesses that have separate legal identity from the owners, like the public limited company and the private limited company. Example of unincorporated is the sole trader and partnership. Sole traders and partnership, whatever happens to the business affects them. But incorporated business, whatever happens to the business does not concern the privacy or the personal wealth of the owners. They are separate legal identity. Is it clear?
Yes.
So we start with sole trader. So a sole trader, who is a sole trader? A sole trader is an individual who owns and controls the business. So an individual who owns and controls a business, that's a sole trader. Is it clear?
Yes.
The advantages of a sole trader, one, the owners keep all the profits. Whatever profit you make as a sole trader, you keep all. Clear. 2, they have complete control. So decisions is about you. You take the decision. It's your business. 3, it is simple to set up. You don't need a lot of money to set it up. You don't need a lot of paperwork. You can just open your business in front of your house here because it's a sole trader. Is it clear? The 4th one I wrote is that whatever you want to do with the business, you can adjust quickly. If you want to change from a barber shop to a tailoring shop, you can change it because it's a small business. Is it clear? So what are the problems of being a sole trader? Number 1, you have unlimited liability. So whatever happens to your business, if your business is owing some creditors, they can sell your car, they can sell your house to pay off the debts. Is it clear? That's why it's unlimited liability. Lack of continuity. I wrote just 3. We don't have to write everything. The second one I wrote is about lack of continuity. Lack of continuity as a result of if the owner of the business dies, the business is over. That means the business cannot continue if the owner is dead. Clear? Is it clear?
There's some.
No, it's difficult. Maybe it's not your own. Maybe it's not your own idea. It's an idea of somebody. So how can you just take up people's idea? You can't run it the way the owner will run it. You have your own separate, you have your own interest. It might not interest you. You have your own dreams to pursue. Okay? The 3rd one, we find difficulties raising finance. That's the 3rd one I write. It's difficult for sole traders to find money, to get money from external source. So most of the time, sole traders use their own personal money to start the business. Is it clear? So go to partnership. So when we talk about partnership, we're talking about business organizations that 2 to 20 people come together to form. The 2 to 20 people come together to form that business with the aim of making profits. That's a partnership. Is it clear? Great. So when you are forming the partnership, most of the time they use a legal agreement, like a document that will guide what the partnership operations is about. We call it partnership deed. That's the partnership deed then. So a partnership deed is a document stating the guidelines of operating the partnership business. So what are those things that you find in the partnership deed? 1, the amount of capital each partner, the amount of money each partner put into the business. 2, how they're going to share profits. 3, the procedures of ending the partner. Because it's a partnership business, they can stop it anytime. We call it partnership dissolution. When they stop the business, we call it partnership dissolution. They have to agree on that. And if they have to take in new partners, there is a procedure for that too. They have to agree on that through the partnership deed. Is it clear?
Yes.
So that takes us to the advantages and disadvantages of. Are you sure? No, I think. Yes. Let me have that, please. I think I didn't make. Okay, yeah, the advantages. Okay, fake. So the advantages and disadvantages of partnership. I think I didn't see anything. Okay. No, it's here. It's here. There's it. So the first advantage, I wrote it is easy to set up and run. It's partnership business. It's just like a sole trader. So you can quickly start. You can call 2, 3 people together and start a business. That's the first point. The second point is that more capital can be injected, unlike sole trader. In sole trader, it is you that can only put money into the business. But in partnership, all partners will contribute money into the business. So you can raise more money, more capital. The last point is that partners can have specialty. You can be good at something. I can be good at something. Abdullah can be good at something. Then we are coming together. That's specialty. Is it clear? Yes. So what are the problems of having go through partnership? Number 1, they have unlimited liability too. So whatever happens to the business can affect the owners of the business, just like sole traders. Second, they have to share profits. Clear? Yes. And the third point is that because we are not the same, even brothers, they do fight. We can have disagreements. So there might be disagreement about things. So that's the problem about partnership. Is it clear? So go to activity 1. Kisulu, Okuma, and Owino. Kisulu, Okuma, and Owino is a firm of a chartered accountant based in Mombasa, Kenya. It employs, in addition to the 3 partners, 16 other staff, and provided a range of financial services for local clients. A deed of partner was drawn up when the business was established in 2010. to raise finance for the business. Each partner contributes 2 million. Sorry. One of the strengths of the business was that each partner was a specialist. So that's all about the case study. Let's just go to the question. So they said, why do you think Kisulu, Okumu, and Owino drew up a deed of partnership? I wrote, they drew it to be able to guide their operations. So whatever the partnership business is doing, through the partnership deed, it guides them on what to do. Clear. The second one said, how does this case study illustrate one of the main advantages of partnership? The main advantage of partnership is that they have speciality. Different people have different skills, yes or no? So as this case, Kisulu, Okumu, and Owino are specialists. One is a cost accountant. They said Michael Kisulu was a corporate tax specialist. Okunu was an investment analyst. Joseph was an auditor. He was an auditor. So they have different skills. So that's an advantage for them. Is it clear? So that's partnership. Then we'll go to franchise. Are you there? So for franchise, what is a franchise? A franchise happens when a business, a franchisor, gives license to another business, the franchisee, to operate under its brand name. So like KFC in Tripoli is not owned by KFC, it's a franchise. So that's what we call franchise. You get it? Yes. So here they say, what does the franchisor offer the franchisee? One, license to trade. That means you have the permission to trade under the franchisor's name. Yes. A startup package, they give you whatever you need to start up the business through their brand name. Training, they have to train your workers to know how they do in KFC, for example. Yes. The KFC in America will do that. The last one, marketing support, they will advertise for it. They will advertise. Whenever KFC have to advertise, you are part of what they are advertising. Do you get it? So what do you give back in return as a franchisee? One, a one-off startup fee. You have to pay a certain amount before you can get all these facility. Two, an ongoing fee because the business continues to run. So you have to give them a certain amount on what you sell, the franchisor. And three, you have to contribute to the marketing cost. So whenever they have to do advertisement, you have to pay certain amounts too from your own outlet. Is it clear? So that takes us to advantages and disadvantages of franchisee and franchisors. So we have advantages of franchise to the franchisee. One, it is less risky. Unlike when you're starting your own business, starting your own business is risky. The risk is high because your business might not sell. But when you are buying a franchise, you are buying a franchise of a business that is successful. So your business might also be successful. So the risk is less. Two, the setup cost, the amount you have to pay to start it up is known. They will tell you, oh, I want to buy a franchise from KFC. They will tell you the price. You would know. Unlike when you have to start up your own business, you will need a lot of money that you cannot know. Do you get it? That's the point. And the top point is that national marketing is assured. They can advertise for you without you paying, without you doing the advertisement, because it's a big company. What are the problems? One, you have to share profits with the franchisor. Two, you cannot take decisions. The franchisor takes decisions about what you do with your outlets because it's their company. But it's your own business now. You are the manager. It's your own. That's why we call you the manager. But decision, you don't have independence. You don't have control over things there. They have control over it because it's their brand name. You have to follow their terms and conditions. The third point, it's expensive to start up. To start it up, it's expensive. I think it's clear. So what are the advantages of franchise to franchisor? One, it is a fast method of expanding. So the KFC in America is in here now, right? Without KFC putting anything to do it here. It is you that buy it. You buy the franchise and you have KFC here. Yes. So it's easy. That means KFC can be everywhere in the world as soon as possible. Do you understand? Yes. So that's an advantage for KFC. Two, it's a cheaper method of expansion. KFC did not put money here. It is you that own it that puts money. So it's cheap for KFC to grow. Do you understand? Franchisee might be more motivated than employees. If it is KFC America that has KFC here, that means it has to employ workers himself. Yes or no? Itself. But here, the owner of this one is a Libyan. Do you understand? So he wants to make the business succeed because it is his own money. So he might do well than KFC in America employing workers here, like their own branch. Do you understand what I'm saying here? Okay. So those are the advantages. Now the problems. Poor franchisees may damage the brand's reputation. If the KFC here in Tripoli is not good, it will affect KFC. It will affect the brand. Do you understand? Two, the amount of money KFC might have to spend on training the people here might be so much. To put them in the highest standard might be much. Three, franchisee, the KFC here might get other companies' products, and KFC will not know. Do you understand? So which is not good. You go to activity 2. But before I go to activity 2, there's social enterprise. So are you there? Right. So for social enterprise, we call them social enterprise because what they do is to help humanity. They want to make people, they want people to live better in a better way. They help the vulnerable ones, those that don't have the financial capability, those that are vulnerable. They don't have basic needs like food, clothing, and shelter. So social enterprises help them. Do you get it? So generally, social enterprises have a clear social objective or social mission. That means they just want to help the society. That's it. Generate most of their income through trade or donation. Sometimes they make people donate for them. That's where they get their money from. And whenever they get the money, they put it back into the business. They don't spend it. And they are controlled by, they are accountable and transparent. That means whatever money they get, they have to explain it to people. They have to explain it to the nation how they got the money. Is it clear? So we just go to the case study, activity 2, okay? They said, what are the features of a social enterprise? Use this case as an example. Like I told you, social enterprise aim to improve human and environmental well-being. Social enterprise aim to improve human and environmental well-being. They want people to be fine, happy. So then they don't want to make profits. That's what it means. So now the second question says, how might charities such as Save the Children raise money? Charities like this will raise money through gifts or donations.
Question 1, explain, use this case as an example.
Yes, the case I said it. This case now, the Save the Children is a charity raise money to run world-class programs to save children's lives and this. What it does to keep it okay? Save the Children raised about 2.1 billion in figure. Look at how they raise the money: gift in kind, order, corporation fund, individuals, institutions, including government. That's how they raise money. So that's why I said social enterprise aim to improve human and environmental well-being rather than making profit for owners. Save the Children is an example. It's an example, yes. Do you understand? Yes. Save the Children is an example of social enterprise. Is it clear now? So the second question says, how might charities such as Save the Children raise money? They raise money through gifts and donations, which is part of what we see in the case study. Clear? Now we have the MCQs. Which of the following is an advantage of a sole trader? A sole trader is independence for owners. They have independence. A or D. Question 2. Having a clear social or environmental mission is a feature of which business? A clear social enterprise, yes. A fast method of growth is a key advantage for business. For which business structure? Franchise. No? Franchisor, yes. It's franchisor. Question 4. Taking risk in a business is a key role of which of the following? Entrepreneur. Entrepreneur.
Yes, yes.
Okay, good. So go to, no. So chapter 4 now. So immediately we go to the case study of chapter 4. The first case study is Qubit Digital Limited and Onday. So the first question, this one's, the first one is, who owns limited companies? Limited companies are owned by shareholders, okay? Limited companies are owned by shareholders, number 1. Number 2, who owns limited companies? Limited companies are run by board of directors. For this example, we have the brothers. For Qubit, they are run by brothers. 3 brothers, they run it. Okay? And question 3. Comment on the size of limited companies such as those above compared to sole traders and partnership. The evidence in this case study talks about that limited companies are bigger than sole traders and partnership. Limited companies are bigger than unincorporated businesses like sole trader and partnership. Clear? We go to activity 1. The Khan brothers own and run a sugar mill near Multan in Pakistan. Khan Sugar Mills Limited was first opened in 1984, and the story is just there. Let me just forget about the story. Then the government needed to set up a limited company. To set up a limited company, you need Memorandum of Association, Article of Association, MOA, AOA. That's what you need to run up to set up a private, to set up limited company, MOA, AOA. Question 2. Who controls Khan Sugar Mills Limited? It is a private limited company and it is controlled by the 3 brothers. 3 brothers control them.
Yes.
Question 3. What are the advantages to Khan Mills of operating as a limited company? Provide 2 advantages. One of the advantages is that it is limited liability. So whatever happens to the business does not concern the owners of the business. Limited liability. And number 2, I wrote Khan Sugar Mills is safe from unwanted takeover as shares are not traded in the stock exchange because they can't sell their shares to the public. So that means they have control of the business. They can't lose the control to outsiders. Is it clear? We go to activity 2. They said, what is meant by the term multinational? A multinational business is a business that operates in different countries. Multinational business is a business that operates in different countries. Clear? Then what evidence is there to suggest that Sony is a multinational company? Sony is a multinational company because it employs workers. Here they said Sony employed over 125,000 people across the world. If you're employing 125,000 people across the world, it means you're a multinational company. And you have factories in Japan, China, Europe, US, and India. That makes you a multinational company. Is it clear? Question 3. They said, describe 2 features of multinationals. Use the examples from this case. Here they said, the strength of the brand has been developed for many years successful. However, so for multinationals, they have powerful marketing and advertising capability. They can market. They can do a lot of marketing because they have the financial capability. They have financial capability, so they can do advertisement and marketing very well. So that's their strength. Is it clear?
Yes.
Now go to the case study. The first one says, which document would be issued to a limited company giving it permission to trade? It is called Certificate of Incorporation. Certificate of Incorporation. C. Clear?
Yes.
Question 2. Which item of the information will be contained in the Memorandum of Association? The Memorandum of Association contains the name of the company. Okay? Question 3. Selling shares to the public for the first time to raise capital for a company is called, we call it flotation. Okay? Floating, yeah, floating. And the last question. Which of the following is a disadvantage of a private limited company? Private limited company, it can take time to transfer shares to a new owner. They cannot transfer shares immediately to new owners. All shareholders must accept to do that.
See.
Yeah, see. Is it clear?
Yes.
So that ends the chapter.